The issue of low earnings is a significant factor contributing to Uber's cancellation problems with drivers. Here's a more detailed breakdown of how low earnings impact driver behavior and the broader implications. 1. Earning structure. Base fare and per-mile rate. Uber's fare structure typically includes a base fare plus a per-mile and per-minute rate. In many cases, these rates can be low, especially for short trips or in markets with high competition among drivers. This can make it difficult for drivers to cover their expenses and earn a livable wage. Minimum trip fare. In some areas, Uber has implemented minimum trip fares to ensure that drivers receive a basic level of compensation. However, this minimum amount might still not be sufficient to cover the cost of operating a vehicle or compensate for the time spent waiting for and completing trips. 2. Expenses and costs. Fuel costs. Drivers are responsible for their own fuel costs, which can vary significantly depending on gas prices and vehicle efficiency. High fuel costs can erode earnings, especially on long trips or during periods of low demand. Vehicle maintenance. Regular maintenance, e.g., oil changes, tire replacements, and repairs are necessary to keep a vehicle in good working condition. These costs can add up over time and impact overall earnings. Insurance. Drivers are required to maintain their own auto insurance, which can be expensive. In some cases, additional rideshare insurance may be necessary, further increasing costs. Depreciation. The wear and tear on a vehicle from frequent use leads to depreciation. As the vehicle ages and accumulates mileage, its value decreases, impacting the driver's long-term financial situation. 3. Low-fare trips. Short trips. Short rides, often referred to as mini-fares, may not provide adequate compensation when considering the time spent driving to the pickup point and the overall distance traveled. Drivers might cancel such trips if they believe the fare will not sufficiently cover their costs. Low-priority requests. In some cases, drivers receive ride requests that are either in low-demand areas or during off-peak times. These trips may offer lower fares compared to requests from high-demand areas or peak times. 4. Impact of surge pricing. Surge pricing. During periods of high demand, Uber implements surge pricing, which increases fares and potentially boosts drivers' earnings. However, surge pricing is not always consistent and can be unpredictable, leading drivers to make decisions based on uncertain earnings. Surge pricing gaps. Drivers may experience gaps in surge pricing periods or find that surge pricing does not fully compensate for the low base fare, especially if they are unable to secure multiple surge trips in a row. 5. Earnings fluctuations. Demand variability. Earnings can fluctuate based on varying demand for rides throughout the day and week. Drivers may face periods of low demand where they struggle to secure enough high-paying trips to make a reasonable income. Competition. In highly competitive markets with many drivers, the availability of ride requests can be lower, which can drive fares down and make it harder for drivers to achieve consistent earnings. 6. Strategies to mitigate low earnings. Increased transparency. Uber could provide more detailed information on fare breakdowns, including how base fares and per-mile rates are calculated to help drivers make informed decisions about accepting or canceling rides. Fare compensation adjustments. Regularly reviewing and adjusting fare structures to reflect current market conditions, fuel prices, and other expenses could help ensure that drivers are fairly compensated for their work. Incentive programs. Implementing incentives or bonuses for completing a certain number of trips, maintaining high ratings, or working during peak hours can help boost drivers' earnings. Expense management support, offering drivers support in managing their expenses, such as partnerships with service providers for discounted fuel or maintenance services, can help reduce their overall operational costs. Improved predictability. Enhancing the predictability of earnings through better demand forecasting and more stable fare structures can help drivers make more reliable income projections. By addressing these aspects of low earnings, Uber can work towards creating a more sustainable and attractive environment for drivers, potentially reducing cancellation rates and improving overall satisfaction.